Thank you. Thanks so much for being here today. We just really enjoy our relationship with all of you. Thanks so much to the attorneys we work with, the CPAs, and of course all of our clients and friends. I'm Susan Martori Baker. I'm president of Cambridge Trust, New Hampshire, and we are just thrilled that you've joined us today for this luncheon. About a year and a half ago, we had the opportunity at Cambridge Trust to welcome a group of colleagues from People's United. And among those professionals were John Traynor, Chris Lucas, and Will Fleming. So you will hear from them today. A look back at 2022 and the roller coaster, a look ahead, what our expectations are for 2023. You probably, some of you have worked with John, Chris, and Will in the past and may know that Chris Lucas is a former Air Force veteran. I guess you're always a veteran, right? He is a senior portfolio manager now at Cambridge Trust, putting together portfolios that meet client needs. John Traynor was Chief Investment Officer at People's United, and he now is responsible for expanding our presence into the Connecticut markets. Will Fleming, he is a certified financial planner, and he's assisting clients to integrate their estate planning with their investment planning to assure that their financial success is met. Today you'll hear from all of them. And we will take questions at the end. So hold your questions so we can hear the presentation. And John, I'm going to leave it to you. I don't know if you'll need the microphone or not.
Oh, absolutely.
Interest rates.
Interest rates are they're going up and they're going down.
There we go.
There you go. And spoken like a true economist. Just so you all understand the pressure that I'm under, I am known as the Susan Martori Baker of Connecticut. So I've got a very, very tough act to follow. I'm going to go through the slides fairly quickly because Chris and Will have got some very, very important points to make. But if you go to the first slide, and I actually had to hunt for this terrible picture of Chairman Powell. He is a very good-looking man, but I found that and I thought, well, we'll use it. As I go through my slides, I'm going to talk a lot about the big picture, the economy, and there are basically three things that I'll talk about. Three things. If you read the Wall Street Journal, you read the New York Times, you read the Boston Globe, you watch. This is all they're thinking about when it comes to the Fed. There are three dates, three time periods. Number one, when are we going to hit the peak? When is the Fed going to stop raising interest rates? We've got a meeting on Feb 1. The expectation is another 25 basis points. We've got the next meeting on March 22nd. The expectation is another 25 basis points. After that, if you take a look at the futures market, the market's basically telling you the Fed's going to stop fairly close to 5%. A lot of other economists, a lot of other people are saying, you know what, the economy is so strong, the Fed is going to have to go higher. So the first date, if you read the story, it's when do we hit that peak? The next time period is what's the duration? The Fed has basically said, wherever we end up, we're going to sit there for a while. And I've got a good chart to show you why they're saying that. But it's essentially the duration. The Fed is basically saying we're going to raise rates and we're going to sit there until we know the economy has slowed down, until really the end of the year. If you look at the futures market, investors are telling you the Fed is going to blink and they're going to start lowering rates in the fourth quarter sometime. So that's the second date. That last date is when does the Fed finally start to cut rates? So peak, duration, and cut. Those are the three. If you read any article about the economy, that's all people are worried about. And hopefully we'll give you some thoughts about what we think, what Cambridge Trust thinks. So if you go to the next slide, from an economic standpoint, we're going to get the first estimate of fourth quarter GDP next week, but the economy is actually in pretty good shape. We're moving along pretty nicely. Inflation looks like it peaked early this spring, about a little over 9%. It keeps coming down, keeps coming down. What we're seeing, though, with inflation is that, we've seen, you're all filling up your gas tanks. We've seen goods inflation come down, what we pay for gas. If you were doing work on your house 18 months ago, you paid twice what you would normally pay for a 2x4. Lumber prices have come down. The price of commodities, copper, they've all come down, which is fantastic. That's the first sign that the economy is slowing. What we haven't seen is really the wage inflation. That's one of the things that we're focused on. Wage inflation is continuing. It's come down a little bit, but it's continuing fairly strong. That seems to be what the Fed is focusing on when they think about inflation. So the economy is actually looking fairly good. Inflation is coming down, but it's still too high. The key issue here is employment. Unemployment right now is at 3.5%. You've got to go back to the Vietnam War, 1969, to see 3.5% unemployment. We're at a 50-year low on this, and we saw some statistics this morning. The employment market is still fairly strong. So these are the three things that we wrestle with when it comes to the economy. The economy is actually looking pretty good. We do believe we're going to see a recession sometime this year. Could happen. Inflation will come down, but how fast we get to 2% is going to be key. And really, the determinant of that is going to be the employment market. So go ahead. I talked about inflation, and I love this chart because the headline number, 9%, 7%, 6.5%. What this chart does is it breaks down all the components of inflation, and it's important to see this. If you take a look at the goods, what we pay, remember we just talked about gasoline and lumber and copper, those prices have come down. But take a look at services inflation. That's actually been pretty high, and it's staying high. So it's that services component. And if you think about services, that's, when you go out to a restaurant, the waiters and waitresses, you come to a hotel, all the people that work in the hotel, services inflation is much more impacted, much more highly impacted by wage rates than commodity. So one of the reasons why services inflation has stayed fairly strong is because it's very impacted by wages. So the headline number, it's great to see that coming down, but I can tell you, Chairman Powell, he's looking at that section right there, and he's saying, unless we see services inflation coming down, we're going to stay pretty strong. So when you see the inflation report come out, it's normally the third or fourth paragraph in the report. They talk about services inflation. That's what Chairman Powell reads first. So go ahead. This is a chart. Actually, it's when we prepared this, we got the latest inflation data. So that 7.1 there is actually 6.5. But this is a great chart. Again, this is what's driving the Fed. The blue line, that's the Fed funds rate. That's what the Fed controls. They're raising that rate. The red line is inflation. In every single period, the Fed raised their rates above inflation. So inflation is coming down 6.5%, but one of the reasons why we think the rates could go higher than 5% is we need to see that real rate. We need to see the Fed's rate go above inflation. So we're not there yet. We're at 4.5%. Market thinks we're going to go to 5% and stop. The Fed is communicating that they may need to go higher than that. So we think rates are going to go up, could go up more than what the market's expecting. If you go to the next chart, you'll see one of the reasons that we think services inflation is staying high. If you take a look at that blue line, that's what all of us in this room, that's what we spend on goods, what we spend on stuff. Cars and plasma TVs and all the different things we buy. Well, because of the pandemic, we couldn't go out to restaurants, so what did we do? We all went on Amazon and ordered a bunch of stuff. So goods spending went through the roof, and we saw that in inflation. Goods inflation went up. The amount of money we spend on services, going out to dinner, traveling, declined dramatically. Slowly, Those two lines are coming together. So it's logical to say goods inflation is coming down. We just took a look at that on the prior chart. Services inflation is probably going to continue going up because we're spending more time. I mean, we couldn't have done this type of a lunch a year ago. What we're spending on going traveling, spending on restaurants, services, will probably keep increasing. So that's going to keep the pressure on services inflation. So again, this is another reason when we look at this chart, it says, you know what, there's a good chance that that services line is going to stay high. All right, so we're keeping an eye on this. Slowly, we think those two lines will come back together again, but they're not there yet. Go ahead. I mentioned, remember that second time period? I mentioned duration. Well, the reason the Fed is focused on that is because of this chart. And this goes back to 1979, 1980. I graduated college in 1982 in the teeth of this recession. It was terrible. Unemployment was over 10%. What Chairman Powell is worried about is this chart right here. Because what happened? You had Paul Volcker raise rates, we had a recession, but inflation really didn't come down enough. And as soon as he took his foot off the brake, the economy picked up, inflation picked up, and what did he have to do? 1982, he had to come back in and raise rates and send rates up. What Chairman Powell doesn't want, he doesn't want to see this chart. He doesn't want to see a double dip recession. If he takes his foot off the gas, as Wall Street is hoping, let's say, unemployment starts to pick up and he's getting pressure from the Congress people to say, you're hurting the economy, and he takes his foot off the gas, this is what he's afraid of. So he's saying we're going to raise rates and we're going to stay there for a while until we see a lot of pain in the economy, which is one of the reasons why we think we'll see that recession. Not a deep recession, but we'll see that recession. But it's this chart, this series that he's very afraid of. He doesn't want to go back to, and we all think about Paul Volcker as being he did a great job, but Volcker stubbed his toe in the early 80s, and Powell doesn't want to do that. Go ahead. This is a great chart, and we could probably have one entire presentation just on this chart. This is one of the problems that we're having with the employment market right now. That blue line, that's the participation rate. That's the amount of people that are in the U.S. and how many of them are working, all right? So you'll see we had this goes all the way back to 1960. We had a tremendous rise up right around January of 2000. We hit a peak, and we've been coming down. Part of the reason for this is the baby boom generation. They're a big cohort, and they're retiring. I think we have 10,000 baby boomers retire every day. Every day. It's just incredible. So demographically, that's been coming down. And if you go on the Bureau of Labor Statistics, they actually work this out, and this line is supposed to continue going down. Slowly, but continue going down. If there's a problem here, take a look at that very last bullet that I've got on the page. If we just got back to the participation rate here, where we were in Feb of 2020, we'd have an additional 3 million people. That would make the Fed's job very, very easy. We'd have a lot of extra workers. There probably wouldn't be the pressure on wages. If there's an issue with this chart, and there are demographers that have spent their entire career trying to figure this out, go back to 1960. In 1960, if you were a man between the ages of 24 and 55, all right, your prime working years, all right, you're probably out of school, you haven't retired yet. If you're in that age group, you were working. In 1960, if you were a man in that age group, 97% of the men in that group were working. 1960, you were working, you were in the armed forces, or you were in prison. That was it. Those are your three choices. Choose wisely. Today, if you're a man in that age group, only 88% of the men in that age group are working. Something dramatic has happened there. These are still the men in their prime working years. If you were a woman here in 1960 in that same age group, I think back in 1960 it was about 40%. In 1980, it went up to 75%. And women have basically stayed at about 75%. So one of the big problems with that blue line, not women, it's men in those prime working years. Part of it is skills. If you got laid off, and time goes by, maybe you don't know how to work the latest machinery. We know that unfortunately, there's an opioid price crisis in the country. But one of the things that we've got to figure out long term as a society is how do we get those men back into the workforce, whether it's training or whatever. So I know one of the things that a lot of people watch when the unemployment report gets reported, you'll see the different breakdowns. How are we doing pulling those men back into the workforce? That would be fantastic, and that would make Chairman Powell's job a lot easier. You go to the next slide. Last two slides when we come to unemployment. Now, this is a great slide put together by one of the firms we work with. And what this shows is that as the Fed is raising rates, unemployment normally declines. This is actually a pretty good period for us. And the Fed is raising rates because the economy is too strong. So we're still hiring people. If you go to the next slide, you'll see that once the Fed stops, that's when the pain starts to come in, because the Fed has basically said, okay, we've slowed the economy. That's when unemployment starts to pick up. So we haven't even gotten to the point where those tough employment numbers are going to take place. One of the concerns we have, and it doesn't matter what side of the political spectrum you're on, but I remember this back, 1980, 1982, when a politician sees that unemployment rate going up, they put a tremendous amount of pressure on Paul Volcker. They're going to be putting a tremendous amount of pressure on Chairman Powell. So, wait, he's going to be called before the House and the Senate, and what are you doing? That's because once he stops, that's when we're going to start feeling the pain. So maintaining that duration, I give him a lot of credit. It's going to be tough. It's going to be very tough, and you're going to be reading those headlines. So I'll just prepare you there. Go to the next page. What I'd like to do before I hand it off is just talk a little bit about what we're seeing in the equity markets. Go ahead. This is last year. If you see, the first half of the year is really where most of the damage was done. That's where, the Fed started raising rates in March. Said, this isn't good. The market went down. But really, from the spring all through the summer, we were basically going sideways. And that was basically just a lot of investors saying, are we going to have a recession? Is it going to be deep? Is the Fed going to blink? Well, we had the Fed was, Chairman Powell was out in Jackson Hole in the summer, in August, and he made a speech. No, we're going to be tough. Okay, so the market came back down. So we were basically going sideways. Now, we could have, a great conversation, and let's talk about why we went up here, why we went down, back and forth. It might be fun, but really we'd be missing the point. If you go to the next slide, a few of the things that we're focusing on are some of the big picture topics which are really more important. I love this chart. A lot of you invest in mutual funds, and they're either growth funds or value funds. The green bars here tell you when growth funds do well. And you know what? If you wanted to beat the S&P 500, just buy, the Vanguard Large Cap Growth Fund, and you would have been the best manager in the country. The white areas are when value stocks do well, more the industrial companies. One of the transitions that we're debating right now is, we've seen this with the growth stocks. You've all seen the tech stocks roll over. Are we entering a period where those value stocks are going to do well? The members of our equity team have been spending countless hours debating this, moving our portfolio. The value stocks seem to be doing very, very well. So rather than debate every daily wiggle in the market, it's much more important to understand there are some big themes going on here, and let's make sure we get the big picture right. You go to the next slide. One of the other things we're debating, and again, this goes back many, many years, 1980, energy stocks represented 27% of the S&P 500. Back then, the energy stocks were the tech stocks of their day. Take a look at 2020, 2021. energy stocks, now, they still moved up, but they dramatically underperformed. Energy stocks got down to about 2% of the S&P 500. Nobody wanted to buy them. They've since moved up to about 5%. We take a look at this chart, and there are all sorts of little wiggles here, but if you didn't understand the big picture, you were dramatically overweighted energy all the way down and you underperformed. We're taking a look at this chart and we're saying, you know what? There's a good chance energy could do fairly well. So will it go back to 27%? I actually hope not, because the economic environment when it was 27% wasn't very good, but there's a good chance we could see a return to higher prices, a little better performance on the energy stocks. So this is something, again, understanding the big picture is very, very important. If you go to the next slide, this is actually something, okay, well, we'll find that slide, but the slide that I'm going to show you is phenomenal. And here it is. This is domestic stocks, the S&P 500, versus international stocks. And you can see that over time, there's an ebb and a flow. It's not, it's not an EKG. There are big periods here. Right here is where we are. If you just didn't own international stocks and just owned the S&P 500, on a global portfolio, you would have done very well. If you take a look at the economy, earnings, there are lots of things that go into this. One of the big determinants for these swings, international stocks do well, domestic, international, domestic, back and forth. One of the big areas that has a big sway on this is the dollar. I think I've got a chart of the dollar on the next page. There we go. This is the dollar. It's a shorter term chart. If we had a longer term chart in here, you would see that those ebb and flow movements between domestic and international have a big, really correlate very nicely with the dollar. The dollar has done very, very well. It's come down. If the dollar continues to come down, we're probably going to see the wind at the back of those international stocks. And again, it's not, playing the wiggles. We're trying to look for the big picture. So growth value, energy, and international are three areas that we're spending a lot of time. We have our asset allocation meeting today at 2 o'clock. That international chart is going to be the first thing we look at. We're trying to determine, boy, we've been underweight, and it was a great decision to be underweight for the last 10 years. Should we be thinking about our weighting in the international area? And it's not for a day or a month, but are there some big moves to be made here? So one of the things that we would advise is just keep your eye on the big picture. So I'm going to end there, and I will hand it off to Chris.
Beautiful. Thank you, John. Okay. Everybody hear me? There we go. So I'm going to pick it up and go into a subject that I'm sure you've all heard the term, deglobalization. There obviously has been a number of different events that have happened over the past 3 years that I'll get into in a minute here that kind of go into this deglobalization push and a structural shift within our economy, not just here in the U.S., but also globally. But before I get into that, I kind of want to take us back in time and talk about globalization, because before we can talk about deglobalization, it's important to understand globalization. And so if we go back, and really let's go back to the fall of the Berlin Wall in 1989, that was a significant event, and that saw the world get bigger. And we saw one superpower. The U.S. was the preeminent superpower. And so what did that lead to? That led to a reduction in defense spending, not just here in the U.S., but also globally. And that from there, we started to spread out ties between different European nations. We began to continue to warm relations with the Chinese. NAFTA was signed in 1994. China entered WTO in 2001. All significant factors. And then we think of a company such as Walmart. What did Walmart specialize? Walmart specialized in looking for the lowest cost of labor, using outsourcing as its tool, and then importing deflation. Significant events that have happened over the past 3 decades. I cannot underestimate the impact that's had on our standard of living and also economies around the world. I'll throw in a side note. We talk about energy. Not only were you looking for, without having any borders, lowest cost of labor, but lowest cost of energy. Look at Russia. Look at Europe. Look at Europe's addiction to cheap natural gas from Russia. And obviously what has happened most recently, that has all transpired over the last couple of decades. Now we fast forward to today's events. We look at the pandemic. So that's number one on the deglobalization push, okay? We had the pandemic occur. Extraordinarily vulnerable in terms of supply chains. We all have seen it, we all understood, especially when an economy shifts from goods and services to primarily goods. We all saw the shortages of critical, whether pharmaceuticals, chips, which we'll get to in a minute, et cetera. And we saw how vulnerable, not only from an economic standpoint, but also from a national security standpoint. The second piece is China. The U.S. is no longer the preeminent superpower in the world. The Chinese are the number two. And it is something that we need to deal with on all levels of government, but also understand their priorities and how they may mix well or may not mix well with ours. Obviously, Taiwan is something that gets talked a lot about, and for good reason. It's not just a tiny island on the outskirts of China, but Taiwan represents 75% of the advanced chip manufacturing globally. So a significant player in the world economy, which I'll talk about in a minute here. And the third piece is obviously the Ukraine-Russia war. That has accelerated a lot of fears about whether you thought 3 years ago that this world was a scary place, a dangerous world. Well, a lot of us now do, especially if you live in Europe, and a big wake-up call for the Europeans. So a lot has happened over the past 3 years structurally that we think will have an impact immediately, which I'll get to, but also long-term. And how do we as investors look at the big picture, to John's point, and structure portfolios accordingly? So let's go on to the next page here and start getting in. So we'll start with defense spending. I'm sure a lot of you have heard about this. This goes back to Donald Trump harping on NATO in terms of defense spending. He had his tactics for doing so, but it really has taken this Russian incursion into Ukraine to really wake the Europeans up. If you see here, United States as a percent of GDP, we're at about 3.5%. Greece is just above us at just under 4%. But basically what this is showing it, the majority of NATO members are not meeting their obligation of 2%. It's not enforceable, but that is something they've stated that all members of NATO should be spending. And I think the biggest takeaway here on the right-hand side is the shortfalls. Germany, by far, is short by about 20 billion, and that's a 2022 estimate. In that little box there, you'll see if all of the countries met their obligation, there would be 83 billion annually spent on defense, more than what is being done as of 22. Now, we have seen some progress. We are down from $115 billion shortfall, and we have seen some signs of progress. We've seen Canada, we've seen Germany, for example, order F-35s, which are manufactured by Lockheed Martin, the preeminent stealth fighter. Those are all good signs. We need to see more of that. Not just for the United States, for European security, but there are a lot of different hotspots around the globe. So that is a big shift that we're going to be seeing. I also want to highlight on this page two other things that are NATO-related and not NATO-related. One of the big outcomes of Russia's war in Ukraine is Sweden and also Sweden and what's the other? Denmark. Thank you. And Finland going into applying for NATO membership. That's a huge move. Those are countries that for a long time have said we're going to be neutral. A lot of training and equipment is shared with NATO allies, but they have now applied for membership. It's being held up by Turkey, but that should come to pass sometime this year. That is a huge geopolitical move. The other piece of this is Japan and the Indo-Pacific. Cannot underestimate and look at Japan in terms of its linchpin to any type of situation with Taiwan. We have tens of thousands of troops in Japan, and Japan is now taking a much more active defense and really starting to spend money and will be above 2% in its most recent budget, and most recently is calling for Tomahawk cruise missiles to be added to their arsenal. Extraordinarily important to have Japan's support in any eventual skirmish with Taiwan. And the last thing on this page, again, unprecedented, something we probably wouldn't have seen if we hadn't seen the hostilities that we've seen most recently, is the U.S. and Great Britain sharing nuclear submarine technology with the Aussies, with Australia. And so that was a big shift. That is something that will take a couple decades to build up. But the fact that we've shared that with the Australians, the fact that we will be building these submarines and housing them in Australia is significant. So a significant shift in a world where it was perceived, we pulled our last armored unit out of Germany in 2013 under the Obama administration, and now we're now in a much different world. So whether we perceived it, it was still dangerous. We are now in a much dangerous world, and that's going to have a big impact on defense spending and elsewhere. Let's go on to the next page here. Going on to energy and energy independence, I like to start this by stating that, to John's point here, in terms of energy as a percentage of the S&P 500, we were down to about 2% in 2020. Even before the pandemic, we had an oversupply, significant oversupply. And during the pandemic, we actually saw the crude oil futures go negative. We are far and away distance ourselves from there. Obviously, we've seen a lot of pain at the pump. However, we are very lucky, the fact that we've had a mild winter, not just here in the States, but also Europe, that we haven't seen it get worse. That's been a good thing for us here, but also their economy. But really, when we're looking here, this is the Strategic Petroleum Reserves. And I think it's extraordinarily important to kind of see what we've had to do, not just here in the States, but also globally in a coordinated effort to supply crude inventories to keep levels at a reasonable level. So we've lost about 37% of the reserve, or 220 million barrels last year. We're at the lowest level since 1983. And that is something where the administration has come out and said we're going to start restocking if prices go below $70 per barrel. What does that mean? That means that we basically put a floor on oil prices. So if you're looking at energy stocks, that's pretty good, because you have essentially a floor on the price of crude oil. But what it also means is that we are at a very sensitive period, not just for ourselves, but also the rest of the world. And so just 3 years ago, we thought we had energy independence. Europeans were relying on Russian natural gas and crude oil, and that whole complex has been upended in just a matter of a few months. So energy and crude oil and the supply chains will become even more important as we go forward. I love to go to this page. If you're not familiar with this vehicle on here, this is the Ford F-150 Lightning, the all-electric pickup truck. Ford has made the F-150 for decades. It's been the best-selling truck, and it's an important American manufacturer. An important note, in last year, during the turmoil with energy prices, there wasn't, as in years past, an emphasis on, I like to use the term drill baby drill, in terms of throwing resources and incentives to typical crude oil producers. Instead, in the Inflation Reduction Act that was passed, subsidies for electric vehicle manufacturers, battery manufacturers, solar, et cetera, renewable energy was really on the forefront. And so while that, in terms of climate and the mid to longer term, is fantastic news for energy independence, American manufacturing, the transition is incredibly inflationary. And I think that is an important note. If you look at the sticker price for the F-150 Lightning early in 2022, just over $41,000. After 3 price increases during the year, the ending price is at $58,000, or a 40% increase. That's a significant increase in just 1 year's time, and it all really comes down to supply chain, materials, lithium, cobalt, nickel, which are all major components of the batteries in the vehicles. So while, you go to the next slide. While this is great from a longer term standpoint, in the near term, the transition is going to be inflationary. Same thing here on semiconductors. If you read the Wall Street Journal over the weekend, Chips are the new oil. This is really going to be the new lifeblood of economies going forward. Having access to the most sophisticated semiconductor chips, but also being able to have your own manufacturing base. I mentioned before, Taiwan Semiconductor, 75% of the most advanced chips come out of Taiwan itself. If there was ever a military intervention in that country, that would be devastating for the world economy. Not just the US, not just China, but for the world economy. What are we trying to do with the CHIPS Act, which has led to some of these massive investments by TSMC, Intel, and others when you're hearing about these mega billion-dollar plants across the country? Basically, on a bipartisan basis, which is great to see in Congress these days, the CHIPS Act says we need to have a robust semiconductor economy. We need to make sure we produce it here, we have the raw materials. We cannot rely on China. We cannot rely on solely Taiwan. So in this instance, what we're seeing here is Apple is signed up to be one of the first customers for TSMC's new $12 billion plant in Arizona. That's great news. And actually, the planned expenditure has grown to $40 billion. So great news for investment in the country. However, bottom line is, in bold at the bottom, those chips are estimated to be about 50% more expensive than the same chips coming from Taiwan. So again, if you take a step back, this deglobalization push, we're seeing investment in the US, great, we love to see that. We see jobs being created, excellent. However, because labor, because the expertise isn't here, all this stuff, especially initially, is going to be inflationary, at least in the near term. So next page. And this is where we wrap it all up, and this kind of pulls it all together. So I've talked a lot of negatively about inflation, but I think what I'm trying to do is just show that we're in a different period of time. And what that means is, with a globalized world, we had a different perspective, and investors had a different perspective on what's going to work with markets and what potentially isn't going to work as well. And that's really growth versus value. And that also comes down to, in this chart here, which is a long-term view of the S&P 500 price to earnings multiples. We go back to 1950 all the way to present. What this shows is that investors were willing to pay, on average, approximately just under 14 times on an earnings basis during that period of time. Obviously, there was volatility, but on average, investors were willing to pay 14 times for earnings for the S&P 500. Since the Berlin Wall, that has been elevated. The globalized world, we're paying approximately 19.5 times earnings. So that is a significant increase. And again, we saw the importation of deflation from China and elsewhere. There are many different factors that factored into this. Where are we today? Well, the latest read on where the S&P 500 trailing 12-month multiple is 19.5. So we are right at this line where we currently are after a pretty rough 22 in terms of the markets. Obviously, growth having a worse year than value. So what does that mean going forward? And obviously, that's the key for all of us. So we look at that in our asset allocation team, and we say, to John's earlier points, we think value is going to have an edge over growth. We don't know how long that's going to play out. We're not saying that growth is not a good investment, but we are saying is the period of growth significantly outperforming value is probably over. And I think that is a significant event because the past decade, growth has dominated value. And so as we're building and constructing portfolios, and we're making changes in our core equity or equity income, we are adding to core positions, adding to value positions, and slightly reducing our tech and growth positions in our portfolios. So those are the kind of things that we're taking on a more structural, high-level view, and then boiling it down to our portfolios, how we construct them. Next slide. Now we're going to jump into the market outlook, and I will be brief here. Just want to point out a couple of different things because I think putting things in perspective numerically can be, very helpful, especially side by side. So if we look at the estimate for GDP coming in for this past year, we're going to grow about approximately 2% in 2022. Not a terrible year, especially given the turmoil in markets. However, this is the latest projection for 2023. That's 0.3% on an annual basis. So that's slowing significantly, teetering on, recessionary territory. So coupled with global GDP at 3% and 2023 at 2.1%. Now, I will say there have been some different events that have occurred just in the past month or so, and China being an important piece of this, especially the global growth component. So a lot of projections were being made with China being locked down, continuing the draconian policy. Obviously, they've taken a complete 180 to that approach, and that is playing itself out as we speak. But we do expect to see higher growth in China than initially just a few months ago. So that is a good thing for global growth. And then index returns. Again, in terms of growth versus value, if you were primarily in growth stocks last year, the 1 year 29% drop for 2022 as opposed to the value index of down about 7.5%. So a significant difference between growth and value for 2022. We don't expect that to be as divergent in 2023, but we do have a preference for more core and value going into the new year. The other thing I'll note here, this is our international indexes. If you look at the MSCI EAFE down 14.5%, that is primarily Europe and Japan. That actually outperformed the US. First time it's done so in quite a few years. And really, we saw a nice fourth quarter rally as the dollar continued to decline after going to parity with the euro, and that has been a tailwind for European stocks. So that is a small nugget of good news. On to the next page. This gets into our tactical positioning within portfolios across the board. Right now, we remain slightly underweight equities across our investment objectives. We remain overweight to the US, and we remain underweight to developed markets, Europe, Japan, and underweight to emerging markets. To John's earlier point, we do have a call this afternoon with our asset allocation team. We're going to be discussing the movement in the dollar. We're going to be discussing the mild winter that has allowed Europe to escape without calamity. Basically, there was a chance 3 months ago, looking out, that Europe could have run out of fuel in many locations, telling its factories to shut down production. So some significant changes there. We'll be talking about any changes we're going to be making there. Within fixed income, we're neutral there. We're actually able to achieve a reasonable yield, a reasonable income for the first time in many years. Clients love to see their money markets at approximately 4%. I mean, that is a good thing. When the one note I'll point out here, below investment grade, that is a low or small piece of the portfolio, the fixed portfolio. But that lower duration, lower interest rate sensitivity has actually helped us to outperform in 2022 as non-investment grade has actually held up better than anticipated. Next page. Wrap it up here. And so just kind of tying it all together, this is a look at the sectors within the S&P 500. And this is typically, this is your typical cycle. We believe we are in kind of the late cycle currently. And so you'll see, this mirrors very closely to how we're positioned. I talked about how we've been reducing technology sector, consumer discretionary. That's where you've seen retail sales the last couple months with November and December, basically dropping 1% month over month. So you're seeing weakness there. So we've been just trying to limit our exposure there. Consumer staples, companies that can return income to investors and also maintain margins. We've been a big fan on, and obviously energy. We've been increasing our energy exposure throughout the year. ExxonMobil, Chevron, the energy sector in 2022 was up over 80% to give perspective on some of these numbers. So that was really where you wanted to be. So I will hand it off to my colleague, Will Fleming. What I will say before I give the microphone to Will, what John and I do up here, talking about investments, talking about equities, that's the investment management piece. What Will does is he takes that and translates it into the wealth management piece and the financial planning piece. And as we've all seen over the past 3 years, I mean, if you don't have a plan to fall back on, whether the pandemic or this past year, you're in tough luck. It really makes what John and I do, meaningless. So I'm going to hand it over to Will here to take us through some planning.
Thank you, Chris and John. It's a pleasure to have the opportunity to speak to you all today. Like Chris had just mentioned, my name is Will Fleming. I'm a certified financial planner. I'm also a member of the financial planning team at Cambridge Trust. And part of my role as a planner is to sort of do what Chris was just saying, integrate everything that Chris and John just covered with the specifics of a client's personal situation. So taking into consideration things like their personal tolerance for risk, their goals, their time horizons, their family dynamics, their medical history, and out of that, we're able to create a comprehensive financial plan with actionable next steps. Because at the end of the day, people want to know, what does all this mean for me? Right? What is, given all this economic data, what is the impact to my family and myself, and how do I best take advantage of this type of information? We're able to provide actionable and insightful or meaningful insights through the creation, the implementation, and the ongoing monitoring of a financial plan. So today I just want to spend a little bit of time talking about the financial planning offering at Cambridge Trust. To get started, I believe that everyone needs a plan. Everybody needs a plan for many reasons, but perhaps most importantly, a financial plan creates a roadmap on how to get from point A to point B. And in doing so, it serves as a reference point from which we can measure progress over time. So we, year over year, we have a way of tracking, are we on pace to meet our goals? If not, the planning process will highlight the need to make adjustments when necessary. It also gives us the tools to evaluate which types of changes are most appropriate. I think that those benefits are always evident, but perhaps they're of particular importance during uncertain economic times. So when markets are down, when returns are off, when the economy seems a little bit shaky, we want the ability to go back to our original or maybe most current plan and to reconfirm that the goals and objectives that we put in place are still current, they're still accurate, and that the strategies and the plans that are in place are still supportive of those goals. This reminds me of a quote from the great Peter Lynch, who I'm sure many people in the room are familiar with, but if not, Peter Lynch was a famously successful portfolio manager, mutual fund manager at Fidelity Investments in the 70s and the 80s. He ran the Magellan Fund, most notably. But he's famously quoted as saying, "Know what you own and why you own it." And I love this quote. I think it really gets at the heart of everything that we're talking about today. If I were to take some inspiration from that quote and make an analogous slogan as it pertains to financial planning, it would be, know your plan and why you implemented it. And it's really having that, that reaffirmation of the goals, reaffirmation that the plans we put in place are supportive of those goals, that allows clients and allows us to be more consistent in maintaining strategies over time. And a higher level of consistency leads to better outcomes. You go to the next slide. So the financial planning team consists of certified financial planners. We have accountants, CPAs, JDs, attorneys, we have CFAs. We have a very deep pool of individuals that we can, actually, go to the next slide, I'm sorry. I'm one slide off here. A very deep pool of individuals and resources that we can pull from in-house, but we're also very happy to work with outside advisors, other accountants, other attorneys, because ultimately we see ourselves as part of your financial team. So the financial team begins the planning process simply with a conversation. We get to know you at a deeper level. We get to form or establish a baseline of your financial life, which is basically everything that you're currently doing, contribution rates, withdrawal rates, your taxes, the way that your accounts are invested, your goals, and so forth. And using financial planning software, we can project that out 1 year, 5 years, 10 years, 30 years, whatever the relevant timeframes are, to see where that gets us. And then from there, we can create other scenarios to address those what-if questions. So there are lots of different what-if questions that we could pose. Some common ones are, simply, what if I worked longer? What if I retired sooner? What if I become disabled at a certain point in my life or die prematurely? What's the financial impact to my family? What if the laws change and my tax situation is different or my state plan shifts? What if medical costs are higher in retirement than I anticipated? So again, there's a number of different scenarios that we can run, but the real benefit in this approach is that we can compare and contrast those scenarios to your baseline. And that allows us to determine whether making a change to your financial plan is going to impede or improve your progress towards goal. And it's having that level of clarity that allows for better decision making. Good, next slide. I don't have nearly as many slides as the other folks, so don't worry. Financial planning topics are pretty vast. There's a lot that fit under the broader umbrella of financial planning. Here we've listed 6 that we feel represent the fundamental building blocks of a solid financial plan. Now, I'm not going to go through each one in any great level of detail, just due to time constraints. I think those conversations are best had as a one-on-one with myself or someone from the financial planning team. But I did want to touch on a high level of how these topics relate to each other. For most of our financial plans that we develop, having a detailed understanding of cash flow is absolutely paramount, because cash flows drive or impact every other aspect of our financial plan. They're the primary driver of our ability to fund accounts, ideas, gifting strategies, business interests. They have an impact on our tax situation. They impact retirement planning, whether we're contributing to or distributing from various types of retirement accounts. Cash flows can also have an impact on our willingness or our ability to accept risk. Our appetite for risk will then drive our investment allocation across the board. So it's really a central focus of planning because, again, it feeds into every other aspect. Once we have a detailed understanding of cash flows, we can layer on other aspects of financial planning to get a little more granular. So just at a high level, if we're talking about tax optimization, we're really discussing ways to mitigate taxes throughout the year when possible, really being strategic about the types of taxes that we pay, and obviously that has a positive impact on the growth of your assets over time. When talking to clients about wealth transfer, I think it's important to note that we don't draw up any estate or trust documents in-house. However, we do have a full fiduciary department that's capable of reviewing statements or documents, rather, making suggestions, recommendations when necessary. We can fully administer trusts, and we can help execute any multi-generational wealth transfer or philanthropic giving strategies. Most of our financial plans have some element of retirement planning embedded in the conversation, and retirement planning is an extremely vast field. It covers many, many different topics. It addresses things like longevity risk or outliving your money. Most notably, recently, inflation concerns. There's liquidity concerns, obviously market risks as well. But I think we could probably have a whole seminar just on retirement planning alone because it is truly so vast. Part of retirement planning is also asset allocation analysis. It doesn't have to be. It can certainly be a standalone topic in and of itself. But asset allocation is extremely important because it's the primary driver of long-term returns in our portfolios. So we want to make sure that all the good work that John and Chris are doing from a portfolio level, that we can assume the right or the risk that a client is assuming is properly aligned with the goals and intentions for that money. So it's finding that right mix of stocks, bonds, cash, alternative assets with respect to the other assets that you may have in your net worth, your real estate, business interests, and so forth. So that's dialed in so that we can make sure that we're achieving our goals. Asset allocation also deals a little bit with, or oftentimes does deal with, concentrated positions, either in public or private companies. But that ties right into risk management. There's a lot of different types of risk, not just financial risk. There's legal risk, health risk. We're able to offer education around these types of risks so our clients can better navigate this arena. They can avoid pitfalls and ultimately have better protection for their families. So in closing, the financial planning group or the financial planning team can develop a detailed picture of where you currently are in your financial life. We can help to identify future goals throughout your life and create roadmaps on how to get there. We can also help with wealth transfer at the end of life. We're going to provide recommendations and adjustments along the way. This adds clarity to decision-making so that ultimately you can be confident that you and your family can live your best life. Thank you. I'll give it back to Susan.
Thanks very much. Now you know why we were so thrilled to have John, Chris, and Will join us. And behind them, behind all of us, is a whole team. Wealth management at Cambridge Trust is very deep in its resources, and we're pleased to bring them to all of you. So with that, we'll take questions. Any questions? One in the back?
Two comments, one for John and one for Chris. John, when you're talking about the current unemployment rate of being 3.5%, it'd be nice to have 3 million more people in the economy to put less pressure on the Federal Reserve and Chairman Powell to have higher rates because there would be less job inflation. It seems like it's still a very delicate tightrope because there's always that statement that the ideal unemployment rate is actually 4.5%. Can you speak on that?
Yeah, what you're referring to is something called NARU. You know, the natural rate of unemployment, which is, as you said, right around 4.5%, maybe a little less than that. And when we dip below that, where we are now, 3.5%, we've actually got a chart on that. I pulled it. I put that chart in there. That's when we get into the danger zone. And just, some people may not have heard the early part of your call. You're asking about, you know, the pressures that 3.5% unemployment rate are
Right.
putting on Chairman Powell, correct?
Right, so you're saying if you add 3 million more people, there'll be less pressure on Powell, but then the unemployment rate would be lower, and then so it's a tightrope there.
Exactly. What he's working, you know, there's a statistic out there, the job openings, which is currently around 10 million, and then the unemployed people, 5 million, 6 million, in that range. But right now, for every worker, for every one of us, there are 1.7 job openings. That is an all-time high. Normally, it's about 0.6, meaning, you know, we have unemployed people. So we're way off the charts. What Chairman Powell is hoping is that as we got a lot of business people in here, as you're sitting there saying, boy, I've got 5 openings, rather than lay people off, what you're going to do is you're going to say, okay, the economy's slowing down, let me get rid of some of those openings, and I'm going to hold on to my current people. So what we're hoping is that we still get more people into the workforce, but in order to have a soft landing, rather than have massive layoffs, what we're hoping is that we see those job openings start to decline. Companies say, okay, maybe we don't need those extra 2 people that we've been looking for, that we would have had to pay up for. We'll see that number come down. That's what Powell was hoping for. That's sort of like hitting, you know, the perfect pitch. We hope he's successful. Chances are he won't be. Chances are we're going to have some pain. But what he's hoping for is not that we have massive layoffs, but that those job openings come down. Is that touching on the question that I asked?
Yeah, it was just how you navigate that delicate tightrope that you're on.
And he's steering an aircraft carrier. I mean, think about it. We haven't even gotten to the 12-month anniversary of 0 interest rates. Last March, we were at 0, and the Fed was still doing quantitative easing, still buying bonds. You know, we're still, you know, not even 12 months into this, and normally the impact of rising rates don't start taking effect until about 12 months later. You know, we're starting to see this in the housing market. You know, the FHA, just to give you a sample of how this has impacted the housing market, the FHA last month came out with a statistic. Just because mortgage rates have risen, 3% up there, we're 7, I think they're about 6.5% now. 15 million people, primarily first-time home buyers, were taken out of the market. They no longer qualify for a mortgage. So that's the impact that the Fed has had, and we're not even at the 1-year anniversary of them raising rates. So, you know, he's trying to do this. I sure hope he hits his employment number, because we get rid of those job openings. Chances are we're going to have some pain. Chances are, I wish him all the luck, but I as a betting person, I would bet against that.
Thank you.
Yeah, great question. Great question.
And now for Chris, when you were talking about the defense industry and how important that is, it's interesting that actually in the defense world we're seeing more globalization even though we're seeing deglobalization in industry. And they used to talk about interoperability. Now, because there's so much international cooperation, they're actually talking about it being interconnectivity rather than interoperability of all the various platforms, be it Army platforms, Navy or Air Force platforms. In addition, you have so much activity with drones, both smaller ones for surveillance as well as bigger ones for munitions dropping. And you also have all the increase in the anti-missile type of activity for Raytheon with the Patriot and all the rest. So all those are driving the defense industry forward. And even the stalwarts, they just projected that they're going to re-engine the B-52s, which came out in 1950. With old Pratt & Whitney engines, they're going to put in some Rolls-Royce engines in them, and they project that they're going to go to 2050 on the 100 years on the B-50. They don't build them like that anymore. But they're dropping out the F-22 Raptor already, but the B-52 is going on.
Yeah, and so what I'll say on that is, we talk about deglobalization. One term that you might have heard that I did mention is friendshoring. So I think that's a big terminology. So, we may not see, manufacturing fully come back to the States, but we're seeing a lot come back to Mexico. We're seeing a preference for European allies. We're seeing a preference for doing business in Taiwan, Japan, etc. So talking about interoperability, one of the countries I would focus on is Turkey. Turkey has been an ally for a number of years, member of NATO. Turkey was booted out of the F-35 program as they were a major manufacturer because they purchased an advanced missile defense system from Russia, which we deemed a national security interest. So we're now moving that out of Turkey to other European countries. So I think there will definitely be, not just defense, but in other areas, this friendshoring going on, which, again, not necessarily lowest cost of production, but it will, from a national security standpoint, it's going to be very, very important.
So, Mel, can we let someone else ask a question?
Sure.
Hillary, I'm
I just have a question for John. I was confused by one of the graphs you had, which is the workforce participation. If it's only 60% participation, but we only have 3.5% unemployment, what's going on in the middle?
We've got, you saw that participation rate. We've seen the rate of people in the workforce decline, all right? What we need are more workers. We're down, the economy's booming, we're at 3.5% unemployment. If we could get more workers, it would make things, we'd see the participation rate go up, and we'd also hopefully see a little bit of a relief on the wage pressure. So,
Who are the people not participating? Are they able to work, or are they...
What he's getting at is they disappear out of the statistics.
oh, okay. Yeah. We've got a lot of people that don't even show up in that unemployment rate. Unfortunately, it only counts the people that are actually looking for work. So if you're out, you're out. We need to get those people back off the couch, basically. I'm sorry that they're not working. They're doing something. We need to get them back into the workforce. Absolutely. There are a lot of people that don't want to work. I know there's remember Senator Phil Gramm? Okay, he wrote an op-ed for the Wall Street Journal maybe 2 months ago. I've got it, if I can send it to you, where he did that, and he took a look at all of the benefits, that came out, and he said, you know what? You can actually do pretty well by not working if you're, with all the different subsidy programs. So there are a lot of people that aren't working by choice. Saying, you know what? Okay, maybe I won't have I can't afford the summer house, but I can pay my bills. So yeah, we've got to pull those people back in. We could have a great debate about immigration. You know, I mean, it's in the headlines every day. But bottom line, we need more workers in this country. We, certainly, be legal and pay taxes and do all those great things, but we need more workers. So,
Thank you, and thanks to John, Chris, and William for excellent presentations. I have two questions. One, there seems to be at least a minority point of view on Wall Street that the era of low interest rates is gone forever because of the vast expansion of government debt, because of the labor participation rate, which you touched on articulately, plus globalization, meaning that we are going to continue to have a labor participation gap. And that has implications for investments. If you believe that the argument goes that interest rates are not going to come anywhere near the 2% target this time, it favors equities, it favors inflation, inflation-adjusted bonds over traditional bonds. And I was wondering what your view was on that.
I think that's a great point. I would never say never because we don't know what the future holds. But I think every point you just made is spot on. And I think one of the points that I should have emphasized a little bit more on the last page, we were looking at the price to earnings multiples, is does the Fed get us back to that 2% long-term rate of inflation? And that's a big question mark. They have come out and continued to say that's the target, but what's the ramifications if that goes up to 2.5% or 3%? That is going to have ramifications. It's going to have ramifications on how we invest, and that would lead to higher rates, not just here, but also globally.
Yeah.
So,
think about that one chart that Chris put up on globalization. I mean, you had Deng Xiaoping. It was in 1978. Took over after Mao and basically opened up the economy. We had the Berlin Wall fall in 1990. Allowed Russians and Eastern Europeans to come in. So, since 1980, really, we've had a glut of workers. 1 billion people came out of poverty, in primarily a lot of Chinese, but Indians, Africans. We had a phenomenal rush. Now that's been great for inflation, because we've had that. If you were a U.S. worker competing against all of those now, very, very cheap workers, you didn't do very well. And that's, that's part of what you're seeing today in the politics. A lot of people are saying, hey, wait a minute. Yes, I know all the people that are over at the World Economic Forum in Davos have done very, very well with all these cheap workers. But, me sitting here in Connecticut and New Hampshire and Massachusetts, I didn't participate all that well. So part of what you're seeing on the political side is the other side of that. So there were huge forces driving down inflation. Part of what we talked about today was those inflection points. Remember, we talked about the growth versus value, international. There are big inflection points that normally you don't see until they're in the rearview mirror. But you could easily make the case that it would be great to get back to low interest rates. But there are a lot of forces right now that are saying, you know what, rates may be higher. Rates may be higher going forward. So we need to prepare for that. We need to think about that. But yeah, that's a great question. Yes. Oh.
Thank you. My second question really deals with the international situation and asset allocation that you'll be talking about today. We've been through boom and bust in energy, which you touched on, certainly during my lifetime a number of times. We've been through inflationary periods, so we understand better how those cyclical changes occur. International investing always has a higher level of political risk, but now when I look at this, particularly with the hot war in Europe, for the first time since the Second World War, certainly even the Cold War ended in 1989, it's a game changer, and there's no end in sight. So when I look at investing, my level of concern, given the greater level of uncertainty, just because of political risk goes up. And I might also note with China, I mean, something, we had this relative concordat with them where they produced cheap goods for us and they bought our treasury bonds, and it worked until it didn't work. And now you have one of the few issues where there's bipartisan agreement in Congress is to get tough on China. At the same time, China is flexing its muscles in Asia. And just from a personal point of view, that higher level of risk, which I believe is a secular change, not a cyclical change, is greatly concerning to me. So you talked about the defense investment being an opportunity, but I'd just like your thoughts on just investing in general in the international markets, given what at least I perceive as a secular change in risk.
Thank you. Chris is our defense expert here, but Chris talked about deglobalization. Well, in our presentation, there are actually 4 Ds: deglobalization, deleveraging. I mean, debt is phenomenal around the country. That the deleveraging has got to be a big topic. Demographics. We touched on the demographics just a little bit. The 4th D, the big challenges that we see, is democracy. That if you take a look at what's going on in China, you take a look at what's going on in Russia, the undercurrent, and I subscribe to Foreign Affairs, and there are just so many great articles in there talking about there's a real assault on democracy. That free markets and free people, well, the Chinese are saying, hey, that doesn't work. The Russians are saying, hey, that doesn't work. Think about the post-World War II period. Again, a phenomenal period where we all got together and said, you know what, we don't want to do this again. So let's integrate our economies and let's get focus on free people. There's a challenge to that. Right now, there's a big challenge to that, and that's what's going on in a lot of the points that you just touched on. One of the risks to international investing is that we keep going down that path. Chances are, I'll be an optimist and say, well, we're going to lean into that. I think you're seeing some of the headlines, just the fact that, Europe has finally said, you know what, freedom isn't free. We need to step up and do this. The Japanese are saying, holy cow, we need to step up and defend ourselves against the Chinese. So you're starting to see the Western powers say, okay, we've got to renew this effort. So I'm hoping that's the theme that takes place. But when you think about our 4 Ds, that last one, democracy, is really what we see under challenge, and it is absolutely a risk to global investing. Definitely. You hit the nail on the head. So one last question? No? Okay. There's Susan over there. Okay, perfect.
Great. Excellent information. Hopefully you heard something that will really make a difference in your life. Also wanted to let you know that Cambridge Trust is a private bank, so if you have deposit needs, loan needs, whether it's CDs, money markets, we've got some great rates right now, and we encourage you to speak with a relationship manager at Cambridge Trust and talk about your full picture. We want to be helpful. We want you to be successful in your financial life. But thank you very much for joining us. I think we will be here for a little while if you have additional questions that you want to ask. And it looks like it's going to rain, so be sure you see Hillary on the way out. She's going to have an umbrella for everyone. Thank you.